Hey guys, it's Big Mike, and like always, I'd like to thank you for being here today. Today we have another Ask Me Anything with FuturesTrader71. The AMAs are designed to be quick and casual. There's no prepared presentation, and we're going to limit it to 30 minutes. As you guys have questions, you can go ahead and start typing them right now, and then we'll go through and see how many FT can answer today. I'll post the recording on YouTube later today. If you're watching it on YouTube and you like it, do me a favor and give it a thumbs up. All right. And with that, let me give control to FT.
Okay.
How you doing today, FT?
Thanks. Let's see. Hang on. Okay, so let me start by saying trading futures involves substantial risk of loss. It's not suitable for all investors. Past performance is not indicative of future results. Let's see what questions we have here today.
All right, hang on one second. My window got messed up or something. Something happened. Okay, let's see. Not too many people here today. Jade says, what percentage reversal do you use for the zigzag, and does it differ for different instruments? In his case, he's trading the NASDAQ.
Okay, so let's pull up the NASDAQ real quick. So the zigzag for me on Investor RT is based on a number of ticks on a pullback. I'm using 6 in this situation. You can use percentage, dollar amount, number of bars, but I'm using a 6-tick pullback, and actually the NASDAQ is supposed to be 9 ticks, and that'll clean up the chart a fair amount. But generally, it does not measure the next move unless there's a pullback of 9 ticks or more, and that's what I'm using. That's based on an actual statistical study rather than just a number pulled out of the air.
I was going to say, you did a webinar pretty much on that one topic that went into a lot of detail about how you arrive at those numbers. So anyone that wants to check that out, I think the webinar is titled Statistical something. You can search for the words.
You're talking about the one I did for Big Mike?
Yeah, I'm pretty sure that you went into an in-depth, like 1-hour webinar on exactly how to determine those values, or how you do it, how to do the research, so anybody can see for themselves and see if that works for them.
Yeah, and based on their, based on the product they trade, and it's really important to understand that whatever study you do has to be in the time frame, done from the perspective of the time frame that you're trading. So it makes no sense to do a study based on a 60-minute chart when you're really watching a 5-minute chart all day long. So that's you got to have that as a base, and then from there you can just run the statistics like I show in that video.
Yeah, I just found it June 11th of last year, and Statistical Analysis for a Broader Edge was the title of the webinar. I believe that was it. Okay.
That's right. Yeah.
Jade's also asking if you have any other homework tips.
So homework is a broad subject. The key element that you have to address in doing homework is you have to define what it is you're trying to find out. So when I do like the morning trader bites, if you follow me on Twitter at about 7:45 Central or so, I post a link to the Daily Trader Bite, which is on YouTube, which is broadcast on YouTube. It's a live broadcast, and generally I'm going through publicly what I perceive to be the expectation for the day, and you can go to my YouTube page and see them every day. They're right there. And in order for me to prepare for this, I'm generally just looking at okay, what exactly am I trying to define? If the homework, if you're referring to homework as far as research, the first thing you have to do is ask the question, what is your thesis? Like you're doing your PhD, what is your thesis? And then you're going to go and prove it using Excel or JMP or some other statistical package. And because if you don't, what will happen with that approach of doing your research or homework is that you'll end up getting completely distracted from what you initially set out to do, and you'll burn through 6 hours of sitting at your computer crunching numbers, but then ultimately you will not have answered the question that you set out to answer. You have to be very specific with what you want to find out. For example, we did like the overnight study on that video. So the question is, how often, how often in percentage terms does the S&P touch or break the overnight high or overnight low during the day session? So once the market opens, the pit session opens, how often does the S&P test or break the overnight high or overnight low? And then when you go to test it, you find out that the statistics, like 96% of the time, we will break the overnight high or low. So the first idea of the day is, okay, which one is more likely to break and how can I take advantage of that? Usually it's like, you know, an 8-tick move or something that breaks it. That may be your first early trade. But if you're talking about homework in the form of, okay, what is your process for determining how you're going to look at the market the next day? You just simply need to start from a broader perspective. So I look at this monthly market profile chart. It tells me what April has done versus March. It shows me what March has done versus February, and so on and so forth. And it helps me define where the market's likely to go and what condition it's in. And then I start to you know, move to a daily chart. I might look at my SPX chart, which is the fundamentals chart. I look at this about once a week. This has the SPX, and it shows me the put-call ratio. The put-call ratio here, how many stocks on the New York Stock Exchange are making 52-week highs versus lows? What is the volume on a daily basis? Is that increasing, decreasing? And what are the net issues or the advance versus decline on any given day? Is that pushing new highs to confirm the action on the SPX, on the index itself, blah, blah, blah. So you form an idea of what to expect from the outside in, from the big picture coming in. It's a topic that I've covered in depth with the Stage 5 traders as part of a Convergence Tuesday event. I think I spent an hour and a half on it. It's a lot of detail for an AMA, but in general, you'll want to boil down all the information that you're gathering. You'll want to boil that down to a plan pre-market, the same way I'm doing on those YouTube Trader Bites, in that you're getting to the point where you're saying, okay, my key idea of the day, which I'll tell you what it is for today. The key idea for today was for the market to test lower, to open, test lower down to the gap at 66, and then 63.50 on the outside, find buyers, and then push towards 76.75 and 81.50, which you see on this chart here. These are old levels. And what it ended up, so that's the primary idea. The secondary idea is it pushes out of yesterday's range, fails, pushes back in, pushes through the gap, and then tests the 63.50. If it does not hold it, then chances are we'll end up by the end of the day at 55.25. What the market ended up doing, though, is it did both. It tested higher, then it tested lower, held the level that was supposed to be tested first, and now it's moving back up, and it's likely to go to 76.75. Does that ruin my plans for the day? Does that stop me from trading on the day? It does not. What it does do, though, it gives me some groundwork to measure the performance of the market based on what I expect to be what my homework supports as the possibilities. And just having that plan, having actually it's a plan that has at least 3 hypotheses, usually 4 to 5, and all I'm doing then when the market opens is waiting for the market to come to me. I'm waiting for the market to do its thing so that I can know, okay, it looks like plan number 2 is in effect. Oh, plan number 2 was in effect, and now we're back to plan number 1. So now I'm going to stock for a long. I'm going to stock for a long here on my trigger chart. It's a 2-tick Renko. So what in here can I lean on? What can I do in here to get a long that would target 76.75 and then above there 81.50 from where we are now? So my expectation right now, having tested yesterday's close and by a couple of ticks and failing to take out the overnight low and finding buyers aggressively here, my expectation is that the market is likely to test 76.75 now. So my job, instead of sitting here and trying to find areas to trade and trying to invent trades, my job is just simply to observe and measure what the market is doing versus what I expected, and that just gives me the confidence when I put it on the trade that I have some structure or a plan in place for what to expect. If the market acts outside of my expectation, boop, get out of the trade, close it, and then wait for the market to give me the next indication. So that's really the whole point of homework.
Okay.
Beyond that, it's really a subject for a much bigger thing.
All right. And if anyone wants to follow up on that statistical analysis webinar, I posted the link in the AMA thread. It's post number 311. Okay, MT is asking, would you rather advise using a fixed stop and target every time or using context and price action to determine before the trade? He's on a complete mechanical trade management setup.
Okay, so the answer to that, in my opinion, is incredibly dependent on where you are in your development. So if you are someone who constantly does all the homework and does all the work, but then shows up and then all of a sudden are trading emotionally in that, you know, you expected the market to do something, you got in per plan, and then you took a 2-tick loss and then watched the market go and fulfill that plan, or if you got in and then the market went in your direction, went against you and came back to scratch, and you scratched a trade only to watch, you know, 10 minutes later that it's starting to walk towards your targets. If you're someone who's experiencing that a lot, then mechanical trade management is in my opinion the only way to go. In that situation, you're trading emotionally. You don't have the confidence to just let the market do what it's got to do. You're trading emotionally, and if you're trading emotionally, being mechanical is the way to go. And it's a major reason as to why people go to automated trading systems and things like that. They just want to cut the emotion out. Yep. Being mechanical means you put the trade on, you just let it go. Okay, but if you are disciplined, if you feel like you maintain objectivity in the trade while you're in it, not sim. Okay, sim does not bring enough emotion to cloud your logical mind, but live, if you're able to be aware of your emotions and to remain calm through them, then you can move to basing your stops and targets on context, because you're able to actually read context. People who are emotional are like drunk drivers. They're the last to know that they're impaired, you know, and that's why we need to force a mechanical thing. And that's what I do with traders that I work with at S5. Essentially, when I see they're chopping themselves to pieces, I say, okay, tell me how often you got your first scale out. Okay, you know, if it's 5 ticks, let's hold on to a 5-tick scale out. Let's set a mechanical strategy in the trading platform. You can set all kinds of mechanical triggers once the trade is on, and then just the fate of your trade is in the market's hands, almost like a computerized system. And it forces people to be patient, and it forces them to be disciplined. And emotions are a key source of errors, so
Right.
you want to eliminate that. But if you don't have that problem, just you can do it contextually.
Okay, Fran's asking about statistics. He says, have you investigated intraday seasonalities formed on a day of the week basis? And in case you have, would you recommend to use such seasonalities?
This question designed to get me in trouble with somebody. Seasonalities do occur, but I don't believe in the seasonalities that I hear, like, oh, have you noticed that there's always a reversal at 10:30, or have you noticed that Tuesdays are up days, or although statistically this year, for example, Tuesday has been up like 15 out of 19 days. Somebody posted that on the hash FT71 stream. It was Lord Vortex. Somebody posted that statistically Tuesday has been an up day, 15 out of the 19 Tuesdays so far. I don't like to trade from that perspective. That's not something that I can confidently put some size on with and hold on to a trade. I need to trade what's in front of me. In addition to that, is it an FOMC day? Is it not? Is there an announcement? Is there something happening in the Ukraine? It's just there's so much going on an intraday basis. It's like people who say the news does not affect the market. True. It affects the markets for 30 seconds, a minute, maybe 10 minutes, and then the market resumes doing what it does. So a swing trader is not going to worry that GDP is coming out or whatever. But on an intraday basis, we get a lot more sensitive to those movements because we're looking for something that is much more short-term. And seasonalities work better in the long term. Does natural gas get more expensive in the summer or cheaper? Do soybean prices go up or down at this time of year? Does a full moon affect the harvest? That stuff that you find in the Trader's Almanac, I think, has some basis because it has a large enough sample, and it's caused by people's behavior and by nature itself. But intraday, I don't think seasonalities are a trading plan within themselves.
Okay. By the way, there's a thread by Fat Tails, a very popular member on BMT, discussing seasonality. I put a link in the AMA if anybody is interested. FT, I've got a question of my own. So whenever you're doing this homework, largely done in Excel for a lot of people, it's really a form of backtesting in some sense. So do you ever find that certain how to phrase this? Like, do you have a walk forward period or a out of sample period for certain things that you do to test whether or not you over optimized or you've over curve fitted some parameter based on historical data?
Okay, so that's a fair question. So there's the testing that I do is to just find out based on a fixed data set, which the market is not, some habit or something, some process taking place, like how often we test the overnight low or overnight high. When you talk about walk forward, you're talking about more of a trading system type of thing, and that's not what I'm looking for. I take the statistics and I don't trade based off of a statistic alone. To me, context is everything, just like it is in language or in a conversation with anybody. Depending on what came before the current moment, changes what I expect to come next. The idea for me is not to say, okay, 96% of the time we break the overnight high or the overnight low. Now, let's stop the data set at the beginning of the year and walk it forward and see if that 96% statistic holds. I could do that. It would not be hard to do that, but I'm not using that 96% statistic as a trading idea. I use it to support the context of the day. So again, if you watch those trader bites, you'll see that I'm saying it looks like the overnight session did this. It fell off the overnight high very quickly. It is on the other side of the mid of the session, the overnight session. The probability is that the overnight low will get attacked on the open more so than the overnight high. And it's not based on some statistical thing. I know one of those will break. All I'm doing is guessing which one it'll be. But I don't do any walk-forward testing of any kind because I'm not creating a trading system from these statistics. I'm using statistics to support a contextual idea as opposed to using statistics to support a trade idea. A little bit different.
Sure, sure. Very important. Franz says thanks for the seasonality stuff, and he hopes he didn't get anybody in trouble. Okay, Arnie's asking, he says, lately his monkey has been out of control. He tries to hold him back, but the guy sees a tick higher and wants to go wild. Do you advise electric shocks, or what do you advise to try to keep your monkey quiet and calm?
So without a helmet on, what you have to do is smash the back side of your head against the wall. No, don't do that. Recognize that there's a duality within human beings, and you know, our brains are actually created separately as we're forming in our mother's womb, and then the connection is made later. Your monkey brain is formed first, all right? It sits in the back of your head, and it's a very emotional creature, and that's what we call the monkey brain. But don't forget that this is you. Don't treat your monkey like it's some thing that's outside of you that is not under your control. You are in control. It is you. There's no excuse for letting it control your trading. What you have to do with regards to this instinctual and emotional, and that's what it is. It's an emotional response. That's what the monkey is. It's just ego and emotions. What you have to do is simply recognize that it's there. So recognize what, oh gosh, I feel myself getting upset. Like I'm getting angry that I missed this trade that actually worked out. And then what you have to do over time is like you have, I don't know if you've read the book, The Power of Habit. What you have to do over time is that becomes your cue. The cue is, I missed the trade, I'm getting pissed. That's the cue. The routine is to chase the market and try to make up for the fact that you missed the trade. The reward in that cycle is, yes, I got paid to do that 1 out of 10 times. And then generally the cue and the routine dictate the process because you're doing something to allay the pain or to satisfy the pain, but the reward is not there, yet we keep doing it over and over and over. And that's just how we are emotionally as human beings. Right. So the important part for you is to recognize what triggers it. What gets me to be this way? I've done all the homework, and I'm still acting like a crazy person. That's what you have to be aware of.
Right. I want to ask you about, this is my question, about atmosphere or mindset. Like, you know, some people actually will literally meditate before they start trading. Some people have a very quiet office, you know, with I mean, you can hear a pin drop. Some people have like the pit noises in the background, or lots of noise, or they're trading in an office with a lot of ambient noise. You know, what do you think? Is it up to each individual, or is there a point of which, you know, there's like overload, not necessarily information overload, but like audible overload where it's distracting, versus somebody that tries to, you know, the opposite end of that is someone that meditates before they trade each morning, someone that tries to be so calm and so focused. Is there middle ground somewhere?
That's an awesome question. You know what? You just came up with the webinar topic for June, I think. That is such a huge subject that is completely untouched. It's an untouched subject. Most psychology books don't even address it.
Yeah.
But it's a huge part of it. Like, for me, I'm the type that meditates. I mean, there's nothing that can be lost or defeated by the fact that I'm in a calm state of mind. I am centered when I start. Like, think of it this way. Think of a lake, and think a lake is experiencing a storm. On the surface, you have these waves and turbulence. We see it here on Lake Michigan all the time, just splashing water everywhere. But the surface of the lake is splashing, is reacting to physical things happening above, the wind and the rain and all that stuff. But as you go deeper into the lake, the water gets denser and it's stable, it's solid, it's unmoved by the turbulence at the top. And when you meditate, that's what you're trying to do. You're trying to dive deep and be in that space where the water's clear and it's calm, and you're operating from that point of view. I don't care what you're doing in that moment or what you do with your in your life or in your business. There is no way that it would be not beneficial to operate from that level. This is important for golfers. It's important for somebody shooting a free throw that could win or lose the game with the fans in the back, you know, squiggling their arms and those noodles to try to get you to lose. But if you make it about, okay, calm, it's just me, myself, and the market. My job is to operate, to respond to the market, not to create the market, but to respond to it. There's no way that that's not going to be beneficial to you. I don't use pit squawk. I haven't used pit squawk since 2004. It reflects a noise, and it gives me an input that does not help my trading because it creates an emotional response. It's like when people see a long line at a store, even though they're not out shopping, as human beings, we always want to walk over there and find out what we're missing out on. In trading, even though the market's not in an area that you would be interested in trading, hearing noise causes you to start looking for a trade. But that's not your trading plan. A computer system that's programmed to trade certain parameters isn't suddenly going to trade just because, oh, other computers are getting triggered because I can see it in the S&P tick or in the NYSE tick or something like that. It's following a plan. And that's what you need to be as a trader. You need to be bored and patient, and you need to just stay calm. So if you're in a chat room or a Skype group or whatever, where some guy's just constantly emotionally screaming stuff, it's not likely to help you. It's likely to hurt you more than it'll help you if you're not consistent. Otherwise, it is entertainment. That's all it is. It's just entertainment. It fills the space. It fills the silence. We're social human beings. We don't like to be alone.
Sure.
And so we look for others, okay? So that's a great topic, though. I tell you, nobody covers that in your environment, your structure, your infrastructure, your computer, how it's set up. All of that stuff is really, really important. Great question.
No, thanks. I agree. And, you know, on the forum, I see this come up every now and then where people tend to blame their environment for failed trades. Like, you know, the phone rang and I missed a trade. My kids came in and, you know, I missed a trade. You know, that kind of stuff. And I think it's a topic that, like you said, really goes undiscussed of how important. You know, some people kind of call it in the zone. It doesn't matter if it's trading, if it's golfing or whatever. Correct. It's almost like you can see with absolute clarity and you just feel it and you're focused and everything is just, you know, like you can just hear this music playing, you know, it's just so perfect. And
that's called stage 4 of competence.
Okay.
Stage 4, that's what we're after. When I back traders in a prop environment and they're scalpers, we're trying to get them to that as quickly as possible. And getting to that is a function of doing the same habit all the time. And what you're doing over time, believe it or not, our goal as traders, as professionals in any endeavor, is to move the logical things that we do into the intuitive mind. Once you submit it to the intuitive mind, it's like taking something you used to process on your little handheld device and putting it on a cloud that has 100 million computers running the same code at the same time. The processing power in an intuitive mind happens much quicker than our logical mind is able to process it. Something like swinging at a fastball in a baseball game or knowing when to take the jump shot. All of that is committed to the intuitive mind. That's stage 4 of development, and it's the highest level of development you can attain.
Yep. All right. Well, with that, we're actually at the 30 minutes. I know there's a couple questions that we didn't get to. Guys, you can post any questions on the AMA thread, and FT will do its best to get them answered in the coming days or week. And I guess I'll see you back in 2 weeks, FT.
Very cool. Thanks for having me on.
All right. Thanks, guys. Bye.
Take care.